Bonds. Okay, what are the bonds? So bonds, when compared to the mutual funds or with the stock market, bonds are very less risky because they have a matured income, fixed maturity income. Means every bonds, like government bonds we have, what they will do is they will issue uh, a bond with a certain coupon rate. Coupon rate is nothing but an interest rate. They will offer certain interest rate with yearly, some say like 10% interest rate. If they offer 10% interest rate, they will say it has a lock-in period of something like 10 years, 20 years, like that they will release. So, for example, NHAI, National Highway Authority of India, will release as bonds to collect money to lay the roads. For that, what they will do is they will release a bonds worth of 10,000 each bond will be released at the coupon rate of 10% for 10 years. Say, I am saying it as an example. So, what is that means is if we buy such a bond at a 10,000 rupees, we will get an 10% interest yearly into that bonds. It has been accumulated, and at the end of the 10th year, because the maturity is after 10 years, so after the 10th year we'll get the whole lump sum amount including our interest rate. So generally government bonds are very less riskier, and we get an immediate, after maturity we'll get an renew we get that money back to us into our accounts easily. Apart from the government bonds, we have some corporate bonds also. Some corporate companies also will issue that with an interesting interest rates. So when we purchase a bond, the authorized issuer borrow money from you for a fixed period of time. Yes, at a fixed period of time, they will borrow money from us with an interest rate. Like it's like lending a loan from the bank. So likewise, the government is lending money from us, so they will issue bonds for us. Nowadays, that Andhra Pradesh capital Amravati is also issuing bonds. So we can buy such bonds for these many like 20 years. I think they will issue those bonds. They will collect the money. They want to utilize this money for constructing the buildings and development of the capital in the particular state. Like that, NHA will use the money to lay the roads. Like so and so, corporate companies will issue bonds for their capital requirements and thing. So this money earns as a predefined interest rates with regular intervals. Means if they say it is 10% interest rate and they will pay it uh, 6 months or yearly, so we'll get an yearly interest rate, and or they may get at a maturity in period. We can withdraw our bonds at the maturity. We may get the accumulated interest rate and the principal amount also. There will be a different types of that in that. We have government bonds, debit bonds, and junk bonds. Debit bonds are nothing but which is back-ended by the shares. Shares is been used as an backup thing to pay us back. Junk bonds are nothing but which offers a highest interest rate, which are riskier in nature when compared to government bonds and debit bonds and even corporate bonds. But still, compared to other investments in the stock market like shares and futures and options and everything, it is mutual funds. It is a much less riskier thing. That's all about the bonds. Those who are interested in bonds to learn more about the bonds can ask the questions. We'll may try to make a sample video on bonds especially later. So in this lesson we're going to learn about the portfolio management service, or shortly known as PMS. What is the PMS, or portfolio management service? It is the service which is offered by the portfolio managers. Like there we have private portfolio managers, even brokers offers that portfolio management, and some mutual funds of houses also provide us the uh, portfolio management service. In this, what happens is that there will be a professionally trained money manager. What he will do is we will invest a particular amount, like in our India we have to minimum invest 5 lakhs as a PMS. So all the portfolio manager has to be registered with the SEBI, then only they can start the management services. They have certain eligibility criteria for starting the portfolio management services. Those who meet such eligibility criteria will receive the permission to start their portfolio management service. So in this PMS we have a flexibility to choose the stocks based on the discussion with our portfolio manager. We can choose our stocks which has to be in our portfolio. So they will divide our investments and they will do that allotment and everything based on our requirements. So in generally we have another clients known as HNA clients, high net worth individuals. If anyone is having high net worth, means basically they have to invest minimum of 25 lakhs at the starting. So such clients will get an another such specially dedicated portfolio manager who will take care of his all investments and things. That's a different aspect in details. But as a small investors, if we have something like 5 lakhs, 6 lakhs, 7 lakhs, I mean more than any 5 lakhs, we can choose a portfolio management service. We may not get a dedicated manager, but we'll get a relationships managers who will take care of all the investments things. But still we can ask for the specifications of the portfolio managers thing. Even they will manage it very well. We have HDFC portfolio management services, we have Axis Bank management services, we have ICICI Bank wealth managers. You can see ICICI wealth management as a separate establishments in many places also. We can use their services so that they will choose we choose the industries, or we choose our specific needs. Based on that they will suggest the stocks and everything. What is the advantage with the portfolio management services is they will take care of the all the research and everything, and they will invest on behalf of us. So we concentrate on our core businesses and everything, so that it will become an another investment, another income source. So this is the main advantage, but the disadvantage is we may not learn how they are investing. We only know that where they are investing, but we can't get the information like why they are investing in such stocks, what is the research they are following. All this information we may not have available. Yes, and for this portfolio management service they will charge some service charge, like on the profit they will charge maybe 30%, or on the portfolio size they may charge 15%, 5%. It varies from portfolio management to manager. We have to check their previous performances reports. Based on that we can take the decisions. Yes, and we have a right to ask for their performances, previous performances, how they are performing, and how they performed. I mean, they got the profits, and how what is the loss they have incurred, and everything. Based on that, we can negotiate on this management charges also. Thank you.